In this video, we're going to cover how Trump's tariff campaign in 2018 began under much different conditions versus today. So don't expect the past to repeat. Expect it to rhyme. In January of 2018, Donald Trump issued the first tariffs. 5 days later was the beginning of a 10% correction off of the fears of retaliation, a trade war. Well, the market was right to correct. It took 8 months to recover back to all-time highs, and during these 8 months, the trade war was actually heating up, along with inflation, oil prices, and the Fed was hiking interest rates. By the end of September, the market recovered, making new all-time highs until the Fed hiked one more time, dumping the market 20% in a matter of 3 months. Eventually, the Federal Reserve in December announced a pause on rate hikes. Although the trade war was still going on, the market bounced. It stopped going lower, ending the year of 2018 down negative 6%. Now, first and foremost, the market sold off in 2018, 5 days following the first announcement of tariffs. The reality of a trade war not only disrupts the supply chains, but causes stagflation. Stagflation is the worst environment for the stock market, often resulting in deep corrections in often bear markets. When we look at our supply chain indicators in 2018, we can see that growth was falling while prices were rising, indicating clear stagflation. And the rising price component is what triggered the Fed to hike 4 times during this period. And to make it worse, oil prices went from $55 a gallon to $75 a gallon, which is a 50% increase. So what is the takeaway? Tariffs alone are not the problem. It is the escalation of a trade war that turns the economy into stagflation. Rising inflation, rising oil prices, and weaker growth with a tightening Federal Reserve. Now, if we compare that to today, GDP is already slowing while supply chain growth is barely starting to rise. Oil prices are not rising, and the Fed is actually in a cutting cycle for good reason. Jobs growth and the employment picture is weakening. The housing market is already weak, which tells me we are on pace for growth to already slow. So the market will be focused to see if tariffs cause inflation to rise. Inflation is the key component in this equation. Now going back to 2018, the biggest red flag was the rise in oil prices because energy is the main input to economic activity. If Trump can get the oil producing countries along with the US to produce more oil, this would not be the same situation as 2018 because oil prices by the laws of supply and demand would actually go lower. This would help with inflation, which means the Fed can actually be more supportive, maybe lowering rates or keeping them paused. Deregulation in certain industries could also circumvent some of the negative effects from the tariffs. And don't forget about the Department of Government Efficiency ran by Elon Musk, which if successful means